Hi, everyone. Welcome to the Real Estate Private Equity Show. I'm your host, 𝗖𝗣𝗜 𝗖𝗽, and I'm joined by my co-host, 𝗖𝗽 Biniaz, as always. We have another incredible show for you guys today. We have an incredible guest on, Ted Lanzaro. We're really excited to dive into some tax benefits and some tax savings when it comes to investing in real estate. But before we dive into things, guys, please like and subscribe, as it helps us build our channel and allows us to keep bringing you this great content and these incredible guest speakers who educate us.
Yeah, so keep in mind, it's not easy to find Ted, right? To bring Ted on the show, for him to put his time, for us to organize all of this. So all we ask is to like and subscribe. Today, we're focused on tax, and tax is a very important topic because nobody wants to pay tax, right? Or they want to pay tax less, and the rich always pay the least amount of tax. So we got to talk about those strategies.
Absolutely.
With a bit of focus about real estate and multifamily and these syndicated deals. How can there be tax advantages to investors and the general partner?
Yeah, my dad always told me, there's two things you can't control in life: death and tax. So we're excited to hear some golden nuggets from Ted. A little bit about Ted, guys. Ted is a certified public accountant. He's a real estate investor, a real estate broker, an author, and a speaker with over 30 years of real estate tax consulting and investing experience. Now, he's the co-founder of Landmark CPA Group, LLC, a boutique CPA firm specializing in accounting and taxation for the real estate industry. For the last 30 years, he has helped thousands of real estate business owners, entrepreneurs, and investors all over the United States implementing cutting-edge tax strategies that have saved them thousands of dollars annually on their taxes.
Probably millions, or possibly even tens of millions, I would say.
Look at him shaking his head. Mr. Lanzaro is the author of The Tax Smart Landlord and the Tax Smart Landlord Toolkit, as well as over 100 articles on taxation for the real estate industry, specifically for investors, landlords, flippers, and developers. Tex is a sought-after speaker and has spoken all over the United States to groups of real estate investors and business owners on taxation of real estate.
And he's going to be speaking on the multifamily conference with none other than 𝗖𝗑 Benesocky on stage.
Yeah, we're really excited to share the stage together there. Okay. So we can't wait for that. But we know and we believe this interview with Ted will bring great value to both passive and active investors to learn how strategic tax planning of real estate investments could help them generate wealth. Ted, we're so excited to have you here today. Thank you so much for being here.
Oh my God, I'm so excited to be here. Thank you so much for asking me to come on. It's a pleasure.
Amazing. I know you're going to bring so much value. Can you please start off telling us about your background and then your start in real estate, please?
Sure. Yeah. So, my background is primarily as an accountant and a real estate investor. I started as an accountant in the early 90s, and I was working in South Florida for a large regional CPA firm. That's where I started. And I was working with a lot of real estate investors at the time. Florida was really in a big development boom, especially Southeast Florida at the time. And there wasn't much as from a CPA firm standpoint, we specialized primarily in real estate, farming, medical. There wasn't, that's all there was. There wasn't a lot of manufacturing or anything like that. So, I was doing work for a lot of real estate investors, a lot of developers. And I remember a friend of mine, somewhere along the line, I had maybe 5 or 6 years in, and a friend of mine called me from high school, and he says, "You got to read this book." He's like, "It's about real estate investing. It's called Rich Dad, Poor Dad," right? And he bought me a copy over, and I read it. And like a week later, literally, we were down in Fort Lauderdale, Florida, looking for real estate investments, and I got started buying, single family houses down in the Fort Lauderdale area. And as a result of that, and really kind of, I started to also kind of think very entrepreneurially, and I decided, well, I'm going to go out on my own. Right. I was like on a partner track with this firm, and I'm like, no, you know what? I'm going out on my own. I'm going to start my own CPA practice, and I'm going to invest in real estate. And what ended up happening was, as a result of investing in the real estate, I started going to local real estate investment club meetings to network and to learn more and how to buy properties. I went to presentations by, investors. who are doing it, and just like the same way everybody kind of starts their journey, right? And somebody found out that I was a CPA also, and they started asking me, well, what strategies are you using? What are you and your buddies doing, to save money on taxes? And I started telling them, and they're like, that's amazing. You need to do a presentation in front of the group. And I had never done a presentation before, and I literally, the first time, if you could imagine, the first time ever doing it, standing up in front of a room at a real estate investment club with 40 or 50 people sitting there, literally reading off of my PowerPoint slides.
Yeah.
Standing there, and at the time with my knees shaking, by the way, the whole time, right? And it was the first time, but at the end, everybody was kind and they clapped, and I talked to a few people afterwards, and I walked out with a couple of clients, and I was like, hey, this is not too bad. Fast forward now, 30 years, and I do this regularly. I could do it in my sleep. I literally yesterday walked into, a group of guys who wanted to learn about real estate investing without a script or whatever, just started answering questions, and it's become almost second nature. As part of that journey, we also started buying apartment buildings down in the Fort Lauderdale and Hollywood, Florida area, and built up a nice portfolio. And then I started kind of flipping houses. And again, that one of the things that I really loved, I was taking, basically ugly houses and turning them into beautiful houses and reselling them. And so that I was right up until about 2006. That was pretty much what I was doing. I was running my CPA firm and being an active real estate investor, and at that time I decided I was going to move back to Connecticut, where I'm from. And so I sold my portfolio to my partners, and I moved up here, and I started basically doing the same thing. Nowadays, I'm a much less active real estate investor, and I'm a much more passive real estate investor. And the reason that is because I just reached a point in my life where I decided, I don't want to be, running around constantly. I want to spend time with my kids and work on my practice. I wrote the book, The Tax Smart Landlord, about all of my little adventures as an investor, but also the strategies that I was using. And so now that's primarily what I do. I work with real estate investors all over the United States, and I teach them essentially how to do what I call year-round tax planning. It's a very proactive and strategic approach to tax planning that occurs during the year.
Okay.
Right?
Yeah.
And because that's where all the good stuff happens, it's during the year. So I always tell people, look, let me know when you're going to buy a property, when you're going to sell a property, or when you're going to renovate a property, because there's going to be certain things that I'm going to want you to do, both from a strategy and a record keeping standpoint, to be able to minimize your taxes. Because and I say record keeping because record keeping is like the foundation of tax strategy, right? You want to try to be the best that you can be. You want to try to be a good record keeper, and it's things like, let's say, and I'll give you a real life example. I have clients that just bought a large apartment complex, right? And so I'm telling them, and they know they're going to do renovations. So I'm like, listen, you need to take before pictures, like when you close, to the extent that you can go, and as tenants are moving out and you're renovating those apartments, take before pictures. Why? Well, because everything you bought the building, everything that existed in that building when you bought it, you paid for, right? And now when you throw those things away in the renovation process, we want to document, that those appliances went into the garbage, that carpeting went into the garbage, that all of those things, because we're going to write those things off, and then we're going to add the new stuff that you put in onto the depreciation schedule, and we're going to do a cost segregation study. So what we're actually going to end up doing, right, is we're going to end up doing two things. We're going to end up writing off all the stuff we threw away, and we're going to end up taking accelerated depreciation on all the stuff we put in.
We're gonna get into that in a moment here.
Yeah, that's
Ted,
super cool.
let us get to the other questions. We're gonna kind of get into that. We don't want to
get
all the excellent stuff.
But I really like that you kind of were touching point on being a passive investor, and I really wanted to dive right into things. CPI Capital is a real estate investment firm with its mandate to acquire multifamily assets while partnering with investors as our passive limited partners. But maybe you could quickly give us a crash course on the tax benefits that multifamily syndicated investments provide to passive investors, because this is a really exciting concept, and you're the king of being a passive investor in multifamily syndicated investments.
Yeah. So, I mean, I think the biggest one is just from the get-go, is tax-free cash flow, right? And so if you take the concept of investing as a passive investor, what am I really doing? I'm putting my money into a deal, and I'm doing it for a return on my investment, whatever the deal is, right? So I put my money in with the expectation of getting a monthly or quarterly check, right? As part of the profits of the building, and then sometimes I'm also going to get a piece of the back end when the building sells, right? Depending on the deal, right? So during that period of time that I'm investing my money, what I'm looking for is I'm looking for that money to essentially be tax free, and the way it's tax free is that because the operator, the general partners, are going to do the cost segregation study, and they're going to create a first year loss that I may not necessarily be able to deduct against my earned income as a CPA, for example, but I can, I'm going to have a loss on my K1, but I'm also going to have a line item called distributions, which is the money that I receive, right? So that money, if I have a loss on my K1, so I don't pay tax on what I received, I pay tax on the loss that's passed through to me, or I don't pay tax on the loss that's passed through to me, right? And then what ends up happening is I'm able to use that loss to offset all of the cash flow that I'm getting. And I always tell people, and this is a really great point, it starts with, let's say if I'm a high net worth individual, right? And I, let's say I live in California, I'm a tech person in California. I deal with a lot of the tech people in California, right? So if they're making $500,000 a year, say for Apple, right? They're probably paying $200,000 in taxes, right? Between the federal government and the state government.
Mm-hmm.
So that's literally 40%. So I tell people, look, if you're in that situation and you're able to invest in enough syndicated deals using the extra money that you create, right? If you're able to add, say, over a couple of years, $100,000 of tax-free cash flow, right? Well, now you actually are making 500 from your job and 100 from your investments. Now it's $600,000, but you're still only paying $200,000 in taxes. So you've lowered your marginal tax rate from 40% down to 33%, right? That's the biggest way to get your marginal tax rate down. And that's really what you're looking for, right? Now, there's other strategies that we use to help passive investors save money on their taxes, because in many of the cases, they're not going to be able to deduct the passive losses against their ordinary income because they won't qualify as a real estate professional, and they won't qualify as being active in the deal, because by the very nature of being a passive investor, you're not active in the deal. But what can you do, right? So if I use the dollars I receive from my passive investing to fund my 401k, well, now I can get a $20,000 tax deduction against my wages, right? My earned income. So I'm not able to deduct the passive losses against my income, but I'm able to use that money to fund a retirement plan that maybe I'm not funding already. right? So that's one way of doing it. If I'm a business owner, and I can fund a more high value retirement plan like a SEP or or 401k with a profit sharing match, right? Well, I might be able to put $60,000 away. I'm using the cash that I receive from my passive investments that's tax free, and I'm using it in such a way as to create an additional deduction. Does
Cool.
that make sense? Right?
Yes.
Yeah.
So now I say, okay, well, I'm making 500. Let's say I have a business where I'm making $500,000 a year. I'm not funding my 401k with it. I'm not funding my retirement plan, and then I use it to invest in $100,000 of passive investing income. Right. So now my income is at 6. I'm still only paying tax on 5. But then I put $60,000 of that free money, tax-free money that I got into my SEP. Well, now my business income is not 500, it's 440,
Okay.
right? 500 minus the $60,000 tax deduction I got for making a SEP contribution, right? Now my marginal rate is down into in the low 20s, or not low 20s, high 20s, right? So I use the dollars that I got from my passive investing in such a way as to create a taxable benefit for myself from my business.
Got it.
So that's another way to do it and get the income down. Now if you can, like if you're a GP in a deal, right?
Yeah.
And you are active in the deal and you qualify as a real estate professional, then that's sort of like the holy grail.
Okay, because I was going to ask you, what are some of the tax benefits for general partners of syndicated investments?
Yeah, they can be amazing, right? So if I can qualify, so I have a lot of clients that can qualify as real estate professionals, right?
Right.
And they're active in the deal, and they either put money in the deal or they're loan guarantors on the deal, right? And for those people, as an example, let's say, for example, you have that same $500,000 of income from your business, and then as a GP, you get allocated $200,000 of the bonus depreciation from the cost segregation study, right? Well, now you can use, and this is what we do all day long, right? Now you can take that 500, deduct the 200 that you got in bonus depreciation losses, and now you're only paying tax on 300. I have clients that will literally wipe out $1 million of income in a year
Nice.
with bonus depreciation because they're involved in so many deals.
And maybe you could just quickly explain, what is bonus depreciation?
So bonus depreciation is when you buy an apartment building. So depreciation is the rational allocation of the cost of a building, right? So let's say, for example, you go and you buy an apartment building for $5 million, right? Now you go and you do, now the IRS will ordinarily tell you that you're able to depreciate that $5 million over 27 and a half years, right? So you're going to get approximately 200, give or take, round math, $200,000 a year of depreciation on the property, and that's what's going to get spread across the partner base. Okay, but what the IRS also says is I can do a cost segregation study and I can break out all of the 5-year property, 5-year property being anything that I can unscrew, unplug, detach somehow, and walk out with, right? So it's all of the appliances, decorative lighting, cabinets, vanities, tubs, toilets, mirrors, lighting, shelving, right? Okay, so on a national average, that's typically about 18% of the cost of a property. It runs between 15 and 20%. There's another category called land improvements. Land improvements are the sidewalks, the parking lot, the landscaping, the retaining walls, fencing, all of the things that you would find outside of an apartment building, right? And the IRS says, okay, well, those are 15-year, those are subject to the bonus depreciation also. So we can take, and they run about 7% somewhere between 5 and 10% on average. So typically you're going to get about 25% of the cost of a building in 5 and 7 year assets. And what the IRS says is you can take the entire amount of the depreciation in year one. So on a $5 million building, you can expect to write off something like $1,250,000 in first year depreciation.
And this is how the cash flows become tax-free, this concept right here.
That's exactly how the cash flows become tax-free, because I could have $200,000 in net operating income, right? Less $1,250,000 in depreciation. I've got $1 million tax loss. So even if I took that 250 and sent out checks to everybody in the form of shareholder distributions, people's percentage of the profits, right? They're still getting a K1 with their share of that $1 million loss.
But can the deficit be rolled over into the next years? Was that your question?
It was a question.
Sorry.
Yeah, no, for sure.
So for passive investors, right, their loss that's allocated to them does get carried over because they're not able to deduct it. It would get carried over to future years. So in most syndications, the passive investors never pay income tax in the first year, and typically don't pay income tax for the first 3 or 4 years. And they only end up, if they end up paying taxes, it's usually in the year the building is sold, right? Because then they're going to be allocated capital gain, and all of the dollars that they get back from that, there's going to be a capital gain portion. But in the meantime, all of the first year depreciation benefits are going to wipe out any taxable income that gets allocated to them for the first 4 to 5 years of the investment.
Amazing. Now, I saw a recent report where it was comparing multifamily investing over the last 20 years to S&P 500, and multifamily, their returns beat the S&P 500. Can this strategy that we just talked about with depreciation, are there other investments like the stock market that this can be utilized, or is it strictly in real estate?
No, this is strictly a real estate concept. There's other businesses that you can use accelerated depreciation and bonus depreciation on, but not like stock investments or stuff. You know, if you have a business, you're able to write off your equipment that way, for example, but it wouldn't be anything in the stock market.
Got it. So isn't it fair to say that even the returns can even be higher because there's tax savings that get added on to the returns you receive from multifamily investing compared to the stock market? I just feel like that is kind of a area where there's not a lot of focus. Hey, there's great tax savings that come with passive multifamily investment. So
yeah, absolutely.
Yeah, no, it definitely. And what you have to look at too, and a couple of the other strategies that we didn't talk about, is while you're not allowed, as a passive investor, you're not allowed to deduct your passive losses from your syndication against your ordinary earned income, you are allowed to deduct it against any other rental income that you have.
That's right.
Right. Okay. So if you're an investor, like a lot of people are, where you have, because a lot of people who get involved in syndications start by having their own portfolio, right? And so they get to a point where the portfolio has matured and it's throwing off, there is no more depreciation, or there's very little depreciation left, and the mortgage has been paying down. And that's when properties typically start to throw off real net rental income that you can't do anything about. Well, investing in a syndication is a great way to wipe out active rental income. So you can invest both passively in syndications and actively in your own portfolio, and wipe out that net rental income. We do that with clients all the time. The other thing that you can wipe out with passive losses is capital gains from the sale of investment real estate. So we use investing in syndications as a way to offset capital gains. So somebody says, if I have a client that just sold, and literally just talking to somebody about this yesterday, they're like, I'm selling a property for $1 million gain. What do I do? Well, investing in syndications is definitely one of the ways that you literally could make that capital gain disappear, because you're going to get allocated, losses that are going to be able to be offset against that real estate capital gain.
And that goes against to that concept where the NOI is 200,000, the depreciation, the tax loss is 1.2 million. So you got $1 million to play with, and that $1 million gets shared between the partners, pari passu, relative to what their level of investment is, and then they can use that not only to make the distributions tax free, also to use the remainder for other rent income that they have, or a sale of a property. So would you say that at times you actually plan for a sale to align with a passive investment kind of, that date of the passive investment, so you align the dates together? Is that something that you advise your clients?
Absolutely. And that's part of that year-round tax planning that we were talking about, because if somebody comes to me today, May 11th, or it says, hey, Ted, I'm selling this property, it's going to have $1 million gain. What am I going to do? One of the first things I'm going to recommend is that they either invest in a syndication or go out and buy another property, right? That is literally, and if they didn't tell me that, if they weren't if they hadn't been taught by me basically to be proactive about this, they might come into my office next year, like, on April 10th, and say, oh, by the way, I sold a property last year. Can you help me save money on it? No, I can't. If you had told me about it when you sold it, maybe I could have helped you, right? So that's the whole thing. That's the real value of being both proactive and strategic, is we're putting things like invest in a syndication into play during the year. Last year, at the end of last year, we had some people that came up. I had some people that came up and they said, look, we need to get rid of $1 million worth of capital gains. How do we do this? And we were literally putting them into syndications. I think one of them literally closed on the 31st of the year. Right?
Yeah.
So
plan ahead with your accountant so that you don't miss out on these incredible tax benefits.
Yes. And now, next question. This is somewhat of a complex question. We might not have enough time to go and completely dissect it, but let's kind of overall go over this idea, which is 1031 exchange, where you can defer your capital gains in a sale of a property, down the road. So now, can 1031 exchanges be used in a syndication model? And if so, some syndications have hundreds of investors, limited partners who've invested it. Does this mean that every single limited partner has to agree to roll over their gains into a different project? Maybe give us a kind of a crash course on 1031 exchange as it relates to syndicated multifamily investments.
Yeah. Well, if your model is, if you're an operator, syndicator operator, and your model is, I'm going to use the 1031 exchanges, I would probably let people know in advance as they're coming into the initial investment. This is an investment where we're planning on doing a 1031, right? That up front, it's written into the agreement that the operator has the right to 1031 your funds, right? That would be the ideal way to do it, right? Because if you don't do that up front and you get to a point where you're going to do a 1031 exchange, now you actually do have to go to your investors and say, look, we're selling this building and we're going to do a 1031 exchange. Because I guarantee you there's going to be some of them who are going to be like, okay, I'm out. Especially if they know they're going to make money. They're looking to get their money out, right? So in that scenario, they could, in theory, prevent you from doing an exchange. Or what you can do is, in some cases, what I've seen is the operators literally buy out those people, right? So if it's one or two or three, let's say you have 100 investors, you might buy out a couple, right? Just to get them out, or drop them out of that. You can also drop them out of the syndication and into what's called the tenant in common ownership, right? But you can't do that with, most people can't do that with 50 or 60 partners, right? So then that ends up screwing things up to some extent, right? But then there's always the alternative, which is, at least now, which is we're going to take the gains in this entity, and then we're going to start a new entity, buy a new larger building, right? Maybe not do a 1031 exchange, but use the bonus depreciation on the second building to help, maybe not eliminate, but dramatically offset any capital gain treatment on building one. And that's always it's always probably an easier way to move the investors around, that you put them all into a new entity and buy a new building. Doing a 1031 within a syndication is tricky if you have a lot of partners.
Got it. Can any of the investors take a portion of their profits out, or all of the profits and their original investment has to be rolled over into a new deal?
It all depends on how it's written. Anything, if you're doing an exchange, anything that gets taken out and given back to the investor is considered boot. So you would be doing basically a partial exchange and paying taxes on some of that. That happens a lot in international, when people are in international deals. So I'm involved right now with one where the three of the 20 investors in this syndication are not US citizens, and in their country there is no such thing as a 1031 exchange, right? So in their country they're going to end up paying the tax on the gain, right? So what are we doing? We're basically creating a strategy where they're not going to be part of the exchange. They're going to actually get distributed out, and it's going to be a partial exchange, and these three people are not going to participate essentially in it. They're going to end up paying the tax. They're going to get the boot. They're going to get their proportionate share of the gain, and then pay the taxes on it, because otherwise they'd end up in a paying the taxes without having the money to pay the taxes. If that makes sense, right?
Absolutely. All right, last question here before we move to the next segment of our show. Our firm, CPI Capital, is located here in Canada. Obviously, we're looking to make the move to the US, but we do partner with a lot of Canadian investors to acquire US multifamily assets, and we're very much involved in this space. And we hear a lot of stories where Canadian investors are either approach or connect with US syndicators, at which time they're told that just create a US entity and you can invest into our investment. Most of these syndicated deals are structured in an LLC, which is not tax efficient for Canadian investors. When you are in talks or advising your clients and they bring it up to you that they're looking to possibly bring on Canadian investors to their deals, what type of advice do you give them? Is it something that, is it worth the headache of dealing with Canadian investors overall? What is the first thing that comes to your mind when someone says, hey, I want to service Canadian investors? Other than saying go and deal with CPI Capital, obviously, other than that, but what do you...
Yeah, well, look, I mean, there's a way to do everything, right? And what I would say to somebody like that is, you need to find somebody who's a specialist in doing that. And the passive investors need to have both a good Canadian chartered accountant and a good US CPA that are going to work together.
Amazing.
Right? And the syndicator has to have good attorneys and a good international advisor CPA who knows the rules, who can basically advise you how to write the agreements and all of this stuff.
All
Awesome.
that fun stuff that we've streamlined.
Because the devil is in the details.
Yes.
Absolutely.
Yes. Awesome. Ted, we really appreciate all the advice you've given. We could sit here all day and just keep
picking his brain.
Picking your brain, but we've got to the end of our show. Now we're on our second segment of our show, our 10 championship rounds to financial freedom. So
whatever comes top of mind when I ask the questions. And here's the first question, Ted. Who was the most influential person in your life?
So I was very fortunate from a business standpoint. I was fortunate to have a really, really good mentor in as the person who ran the large regional firm that I started with, right? And he was a guy who had like about a $10 million tax practice And I remember asking him, his name was Jerry, and I said, Jerry, how did you build this gigantic practice? And he basically told me, everything I do with a client. If I want to play golf, I play golf with a client. If I want to go to dinner, I go to dinner with a client. If I want to go to a ball game, I go to a ball game with a client.
Wow.
And he literally moved in when he couldn't afford it, moved into a very like high net worth country club community in South Florida, just so he could be around the high net worth people who live there. And if you're raising capital, there's a real lesson into that. You got to go where the people with money are.
That's gold right there.
That's
Amazing.
gold. Awesome. All right, Ted, what is the #1 book you'd recommend?
Well, I was going to say, I started with Rich Dad Poor Dad. I know that one has launched a lot of careers. I love that one. I think if you're starting out in real estate, I think you've got to read that one. The one that I love the most right now, the one that I'm reading, is actually called High Performance Habits. And it's a book by Brendon Burchard. And it talks about, putting in place certain habits in your life that allow you to basically perform at a high level.
Nice. Well, I got to read that one. That's really cool.
Absolutely.
Thanks for sharing that. Okay, next question. If you had the opportunity to travel back in time, what advice would you give your younger self?
Oh, buy more real estate. Oh my God. I was fortunate to do very, very well in my real estate investing career. I would be retired and living on the beach in the south of France right now if I had bought everything I'd wanted to buy at the time. And yeah, buy more real estate at the right time. Wow.
South of France, Saint-Tropez. See?
There you go.
He knows where to hang out.
He knows where to hang out.
All right.
Ted, what's the best investment you've ever made?
The best investment that I ever made was actually a redevelopment project that we did. Yeah, it was taking a building and turning it into apartments. And when it wasn't, it was like a kind of like almost a mill, right? And we turned it into apartments. I was part of the development team that did that. It was a lot of fun, a real learning experience, and we did pretty good on it.
Oh, fantastic. Now, what's the worst investment you've ever made, and what lessons did you learn from it?
Oh my God. I was telling somebody this yesterday. I remember when I first started buying single family houses, I can remember I was self-employed during this time. And so as the self-employed guy, I was the guy who went around, literally, I used to go around collecting the rents, right? I used to be the guy when the contractors needed paint, they'd call me and I'd run to Home Depot, right? I mean, like I was their gopher, so that was one of the big mistakes that I made. And I can remember my partner and I went to the door of this single family house, and the guy said, well, I'm not gonna, he's like, I don't have, I'm a little short this month. Can I just owe you the 200, can I owe you 200 of the rent? And as no was about to come out of my mouth, sure, no problem, came out of my buddy's mouth as I kicked him, right? Literally. And you know what? The next month, he was 500 short. The next month, he didn't pay the rent, and the next month after that, we were evicting him. Right now, it wasn't the worst investment I've ever made from the standpoint of we ended up selling that property and putting another tenant in it, selling it, making money, but it was a really valuable lesson. Probably the worst actual investment I've ever made was in the stock market.
Okay.
And just buying stuff based on not having an adequate amount of knowledge, and then getting my butt handed to me in the form of losses.
For sure. What's happening with the markets now? All right.
Yeah. Okay. This will be interesting to hear from a CPA. How much would you need in the bank to retire today? What's your number?
Well, my number?
Yeah.
20 million.
Nice.
All right.
Awesome. Ted is a high roller. That's awesome.
You ever get a burger in Saint-Tropez costs $60?
Yeah. Yeah. Okay. That's true. Okay, this is a good one. If you could have dinner with someone dead or alive, who would it be?
Wow, that's a good one. Hmm. I'm a music guy. I would have loved to have had dinner with John Lennon.
Nice.
Awesome.
All right.
Awesome. Okay, Ted, if you weren't doing what you're doing today, what would you be doing now?
There's a part of me that wished that a long time ago I stopped being a CPA and just continued to be a real estate investor. But I'm trying to learn how to play the keyboard, and so if I wasn't doing this, I would have wanted to be a rock star.
I love it. Nice. All right. Book smarts or street smarts?
You know what? A mentor of mine one time told me that he would take a guy who sold documents door to door over somebody with an MBA. So I would say street smarts.
Okay. Wow. Right on. Last question, Ted. If you had $1 million cash and you had to make one investment today, what would it be?
And it's a very important question. The way it's laid out is $1 million cash, so it's liquid. You can only make one investment, and you have to do it today, meaning like pretty quick here, today, tomorrow. Like I know the markets are closing here pretty soon, but yeah.
It would be in real estate. I mean, I think assuming the opportunity to invest with somebody that I liked and trusted and thought had a good record of doing this, yeah, it would be be a no-brainer at that point.
Real estate it is. All right.
Awesome.
Last question, Ted. If you could just let people know what's the best way that they can reach you.
The best way to reach me is to email me. ted@landmarkcpagroup.com. That I will always get back to somebody who emails me. And during the day, typically I don't answer the phone because I like to concentrate on what I'm working on. So email is probably the best way.
Deep
Amazing.
focus, as you probably got that from the High Performance Habits book.
One of the habits, yeah. Stop answering, stop letting yourself be distracted. Yes.
Awesome.
Awesome,
Ted, thank you so much for bringing such great value today to us and our viewers when we share this with everybody. We really appreciate having you on here.
Thank you. It was a pleasure.